Hello everyone. There is never a dull moment in equity markets, and the current year 2023 is a testimony to this. Indian equities have sharply outperformed many emerging market indices in the current fiscal year. In FY24 till date, India's Nifty index is up 11.5% as compared to minus 0.45% for MSCI Emerging Market Index and 6.5% for MSCI World, all in dollar terms. Now, while the month of August 2023 was more volatile for equities, the highlight for India has been the continued broader market participation. India's outperformance that we have seen so far is been on the back of a trinity of number one, macroeconomic stability, two, strong corporate earnings, and three, flows, both domestic as well as foreign. Add to this the improvement in sentiment has all led to the market outperformance. The macroeconomic backdrop for India continues to remain buoyant. India has been standing out as an oasis in the desert. India's macroeconomic fundamentals look resilient for now, with steady growth, core inflation largely in check, and a fairly comfortable external sector balance. India remains one of the fastest growing large economies of the world. The Q1 FY24 GDP growth stood at 7.8% on a YOY basis. Investment growth in India has seen a pickup led by public sector capex focused on roads, railways, defense, and water. Any acceleration in private capex could further improve growth prospects. More companies globally are also adopting a China Plus One strategy and setting up manufacturing operations in India, boosting the country's long-term outlook. Forex reserves stand at around $594 billion, and this provides the much-needed cushion on the external front. The second spoke in the wheel for India has been flows. Remember, there has been limited investment options for foreign investors in other emerging economies such as, say, China, Russia, or even South Africa. And that is possibly directing flows towards India. This, coupled with strong earnings growth, is making India stand tall amongst these emerging economies. This sentiment has further fueled by the China Plus One strategy that has been prevalent of late, and as a result of which we are seeing strong FII flows. In the month of August 2023, FII flows were net positive. This has been the sixth straight month of inflows. India has in fact been one of the few major Asian economies which witnessed positive foreign flows during the month. Calendar year to date, FIIs have been net buyers to the tune of almost $16.8 billion. Now, while FII flows have accelerated, markets have also been supported by domestic flows in the last few years. Calendar year to date, domestic institutional investors or DIIs have been net buyers to the tune of almost $14 billion. Friends, there has definitely been a perceptible change in retail behavior when it comes to equity markets, with increased participation either directly or through the mutual fund route. Now, the third factor that we are looking at is corporate earnings, and this is the third aspect of the trinity that we were talking about. Now, despite all the worries, corporate earnings has been holding up fairly well. Indian companies reported a profit growth on a CAGR basis of only 5% during the period FY09 to FY20. Now, in contrast, profit growth between the period FY21 and 23 has been at a CAGR of almost 34%. Now, this compares to GDP growth of almost 11% during the same period, and this has resulted in the improvement of PAT to GDP ratio from 2.3% in FY20 to 4.1% in FY23. A lot of the earnings growth has been driven by domestic sectors such as banks, industrials, and automobiles. Consensus corporate earnings estimates have so far been largely stable for FY24 and FY25, and holding on in the range of mid to high teens growth for Nifty 50 companies, with margin improvement being the key driver for earnings growth. Given this backdrop, we remain positive on many domestic-oriented businesses. Some of the themes that we are positive on include the capex cycle revival, increasing penetration of financial services, capitalizing on global supply chain shifts. We are seeking to identify sectors and companies with strong earnings potential, superior management quality, corporate governance practices, but trading at reasonable valuations. Therefore, we are positive on sectors such as industrials, manufacturing, infrastructure, and cement. Some of the other sectors where we are positive on are auto and auto ancillaries, the BFSI space, real estate, and home building. So, where do we go from here? Now, while earnings have clearly been holding up well, valuations have also moved up. Valuations are now somewhat above fair value. The Nifty is trading above long-term average multiples, both on a price to earnings as well as price to book basis, 1 year forward. Similarly, India continues to trade at a premium to emerging markets, and the premium is also now slightly above long-term averages. Mid-cap and small-cap valuations are also above their long-term averages, and on a relative basis to large caps, mid-cap and small-cap valuations are at significantly higher levels as compared to their average rates. Hence, despite strong fundamentals, with a sharp up move in the market, one must be prepared for some degree of volatility in the near term, even as the long-term argument for equities and the India growth story remains largely unchanged. The market attention would, from here on, shift towards events such as the general elections in 2024, the decisions by the US Federal Reserve and RBI, corporate earnings, etc., just to name a few. Some of the key things we would watch out for in the near term would be the inflation trajectory and commentary from RBI regarding the same, the progress of the southwest monsoons. We know that unseasonal weather conditions have impacted food prices, which is likely to lead to higher headline CPI inflation in the near term. On the other hand, core inflation has been stable. Further, vegetable prices tend to be volatile and can potentially correct swiftly as well. Geopolitics remains the other key factor to watch out for. In a market such as this, we would need to keep our long-term investment goals in mind, and therefore asset allocation becomes even more critical. On an overall asset allocation basis, we recommend being neutral to equities in the overall basket given valuations. We are currently somewhat overweight on large caps and somewhat underweight mid and small caps, especially on the back of relative valuations, while even on a 4 to 5 year basis, we would continue to be positive on mid cap structurally. We would evaluate any material dip in the market to add to positions in equities. In conclusion, we urge our investors to maintain a disciplined approach to investing based on their long-term investment goals, risk profile, and definitely focus on asset allocation. Happy investing. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.